Welcome to CARE Conversations with Clarity Financial Solutions, where through education, we move you from confusion to clarity on all topics touching retirement. Join us as we learn and grow from others' experience on entering into the next phase of life with peace of mind and conviction that you have a team of experts to help you, educate you, and let you know your unique retirement is upon you. So it's time to take a deep inhale, a slow exhale, and walk into this next phase of life confident and with clarity. Hello out there. Welcome to a new episode of CARE Conversations with Clarity. I'm Amanda Stilwell, founder and financial advisor of Clarity Financial. And with me today, I have an amazing asset to our industry, Alecia Barnette. She is a senior vice president of the care planning division at Financial Independence Group, and we are very excited to have her with us. So Alecia, tell us a little bit about you.
Thank you so much, Amanda. I'm so excited to be here and talk about a subject matter that I'm so excited about speaking on, which is probably crazy to a lot of people listening. But I've been in the long-term care industry for 27 years. Just to give you a little bit of an idea of what I do, certainly the landscape has changed in the 27 years I've been in the business, but I really go out and I help financial professionals have the long-term care conversation. I also travel across the country and educate your clients on what happens if you need long-term care. What is it? What are the consequences financially and emotionally? And really, my job is really just to help more people. So we're here to educate people, and we're going to do the heavy lifting. So once you decide that, hey, maybe I need a long-term care solution, I'd like to take that off, that risk off the table. My team will help actually do the heavy lifting and find the solutions that are out there, because it's not a one-size-fits-all approach. So we're going to take each individual's needs and we're going to weigh them on, how old are you? How are you going to fund the plan? And we're going to find the best solution that's out there that's going to really mitigate the risk when it comes to long-term care planning. So really excited to talk about long-term care today with you, Amanda.
Thank you. It is a huge topic. I think a lot of people do not want to talk about it. And then some people want to talk about it a lot, like us, because we see it affect people's lives. And it doesn't have to be that way, right? Like when I got into this industry, my goal was to educate to prevent people from eroding their assets due to lack of knowledge. So part of this process is, there's an echo. Do you hear that echo?
It just a little bit. I think it might be gone.
Okay. Well, my issue is just seeing family after family facing this, hard choices that they shouldn't have to make, and they would not have made that, been in that situation had they had some type of solution in place. And it is a different day in long-term care. So let's get into it. Oftentimes when I chat with folks about it, when I finally get them to actually want to discuss it, because a lot of people want to do like this, blah, blah, blah. I don't hear it. I don't see it. I don't want to talk about it. I hear, gosh, long-term care, man, it's too expensive. There's no way. I looked at it a couple years ago or maybe a decade ago, and it's just too expensive. What do you hear? Do you hear that sometimes?
Gosh, I hear that all the time, and too expensive compared to what? And I always say this: if you don't have a plan, your money is your plan. Think of it like this: which asset would you liquidate first to pay for care? Yes, it can be expensive, but there are so many different new solutions now where you maybe don't have to pay in for so many years and not get anything back in return. So, yes, if like homeowners and like, homeowners health insurance, things like that, you pay in. If you never use it, you don't get anything back out in return. So it seems rather expensive for what you get or for the value. But there are newer solutions that will give you benefits whether you live, quit, or die. So is it expensive? Again, expensive compared to what?
Yeah, that's a really great point. I think of it when I'm putting it in a plan with the client. I'm thinking of it like almost like a life jacket around a client's portfolio, not to mention peace of mind, not to mention tax-free. And we'll get into all that. But just making sure that even if you have the money to self-insure, that you're being a good steward of your money and you're just moving basically with the new products, you're moving money from one pocket to another to do multiple things, right? So I I cannot I cannot tell you how kind of I almost cringe when people say that because I've seen the result of people not having a plan in place. And you know, I do have clients, and I'm sure you have people in your life and colleagues and things like that that have had with policies that they did pay for, and they did pay for month after month or year after year, and they went up, and then they never used it, right? Or they couldn't get the company to pay. So I understand where people are coming from. That is true in history, but it's just not the case anymore. So next time, the other thing I want to talk about, people will say when I get to them, because I specialize in the distribution phase of life. So when I meet someone, they're 50, 55, 58, 65, 70 sometimes. And they'll say, I'm too old. I have high blood pressure. I'm pre-diabetic. I won't qualify. Do you hear that?
I hear that all the time. And because the industry has changed and the landscape has changed in the industry, honestly, there are so many products. It's not a one size fits all approach. For example, if you have diabetes, 5 carriers might look at diabetes 5 different ways. There are even solutions now to where you can have cancer be receiving treatment and you can actually get a plan. So don't think just because you have some health ailments that you're not going to qualify, because there are good, better, and best plans is what I like to call it, where you're going to get something no matter what. So they even have guaranteed issue plans, short-term plans, things like that. So again, don't just assume that you're not eligible. These newer solutions as well are more liberal, as I like to call them. They take on more risk and you're able to get more coverage as a result of that versus some of the old school, as I like to call it, traditional long-term policies. So again, don't think just because you have high blood pressure or you have a cancer history, heart disease, even if you've had a stroke, some things like that, there are solutions still available for you. So just remember that when you're in the planning phase.
I know you definitely won't qualify if you don't apply.
And you've never been younger and healthier than you are today, right? Grady.
I have actually in the last 2 years written policies on people who were 70, 71. Obviously, it's better when you're younger, but it's not impossible to find a good fit for people when they want to finally look at it, right? The next question I wanted to ask you, as far as what you hear as you travel around the country, talking about long-term care, people say, I want to self-insure. I've got plenty of money. I won't be here. People automatically think when you say long-term care, they think nursing home, right? They don't think assisted living. They don't think staying at home with a super high quality of life, just having help come in. They don't think that. They think when they hear long-term care, they think skilled nursing unit, and that's just not what it is, right? So that is not long-term care, right? That is custodial care, completely different. But when I hear people say, well, I'm going to self-insure, I'll sell my house, I won't be living here anyway, or, I have enough assets, I just want to jump up and down and say, please, please don't do that. You are leaving a huge opportunity of legacy, or not having to fear that ugly thing behind the curtain that might happen and what that might do to a spouse or whatever that you left behind. What do you hear in that, and what do you say when you hear someone say that?
Gosh, it makes me cringe, and I hate to say that, but it's because I've been in the industry for so long. But, self-funding or self-insuring, whatever you'd like to call it, again, you're just using, again, if you haven't allocated something, you've allocated everything. But I really think it's more, in my opinion, Amanda, about family first, that this is a love solution, in my opinion, because long-term care doesn't happen to you. It happens to your family or to whomever is going to step in and take care of you. And I think that there's just better ways. You can still self-insure, but there's better ways to do that. There's more tax efficient ways, and you can get pennies on the dollar leverage. So, again, when someone says they're going to self-fund, sure, you can still self-fund. Why don't that you are planning on setting aside for long-term care services, whether that's in the home or facility or wherever it might end up. And let's just reposition that money and provide tax efficiencies, again, plus pennies on the dollar leverage. And people understand that have money, that they understand tax efficiencies, right? So we want to try to keep that asset on the balance sheet, but provide that leverage and that tax-free benefit for care. And again, we're protecting the family. And as I've always said, long-term care doesn't bring families together. It tears families apart. So if you've ever been in a care situation and you're self-funding, first of all, your house is on fire and you're trying to plan while your house is on fire, but it's very emotionally, it's very hard for the caregiver, and it's hard to really reactively plan. And then again, what does it look like in your family dynamics? Is typically the oldest daughter in closest proximity. She might quit her job and move in with you. Maybe you might move in with her because again, your life doesn't end, someone else's does. So, family first and then finances. So sure, if you can self-fund, that's great. But why would you do that when you can leverage the insurance company's money in a tax efficient way? And then if you don't ever use it, there are benefits with these newer contracts.
That's right. Insurance by definition is the transference of risk. So by self-insuring, that's what you're doing. You're transferring the risk right to yourself, but you don't have to. You can definitely transfer it elsewhere. I really get sad when I think about the ripple effect that a long-term care tragedy has on a family. Like you said, usually it's the oldest female in the family who's closest proximity. And usually that person is in the middle of her highest wage earning years. And so now she's impacted her family's retirement, and so it just keeps perpetuating a bad situation. I love that you call it a love solution. That's really, I've never heard that before, but it is. It really is. It's preparing a plan so that life can go on. We can continue to work in our jobs. We can continue to go to see our loved one, and they are still our father or our mother and not our patient, right? Because I don't have the ability. It's not in my scope. Even if I wanted to help my parents, if they were bedbound or if they needed specific help, issues or assistance, I don't know I don't know how to do that, and I don't know. I just love that term, love.
And I'll add to that too. I mean, I have a plan so that my kids can supervise the care rather than provide the care. Mm-hmm. I'd rather them wipe my brow rather than my behind, not to, put it all out there. You know what I mean? Like I have twin boys, they're 17. That's not really something I want them to do. And I also want them to talk to each other when I die because long-term care doesn't bring families together. It tears families apart. And I've seen, kids when their mom and dad died, never talk to each other again. That's just horrible. Why would we go down that path when we can do something else to take that burden off of them?
I have a client that I was helping with retirement, just buttoning up the last pieces, and he and his sister have some shares of stock, true certificates. And because of the way their parents passed, and she was the one taking care of them, and he was states away, there was such animosity among the two of them because of that 2 years after the death of their parents, they had not spoken to one another. And the reason why I bring up the stock certificates is we were trying to sell them to create a retirement income play for him, but he was scared to death to call her, and liquidate an asset that neither of them needed, but even a phone call. So, okay. All right. So the next question, and we've kind of discussed this already, but I don't want to pay for something that I may never use. That doesn't seem like a good return on investment.
Oh my goodness. I can tell you that that's probably the number one thing I've heard in my entire career. So when I started 27 years ago in the long-term care industry, the only solutions that were really available were traditional long-term care policies. And I like to use the analogy renting versus owning. So renting is kind of like a traditional long-term care. It's the cheapest way to leverage the most amount of long-term care services. But as you mentioned earlier, is rates can go up. I've seen, some of these older policies, the rates go up anywhere from 15% to over 200%. Really, it's awful. Now, I think there's some rate stability now, but there are no guarantees. Those can still continue to go up. And then, of course, the $1 million statement is if you don't use it, you don't lose it. You pay in all these years, and there's nothing that you can get back out in return. And that's been, again, the biggest hurdle or the biggest objection I've heard my entire career. And renting isn't always appealing, and you have people that would rather own. So these newer solutions called asset-based long-term care, it's like owning your policy. You have a benefit whether you live, whether you quit, or whether you die. And that's, maybe it might cost a little bit more, but people like the value proposition of having the guarantees. And again, it gets completely rid of the objection. If you don't use it, you don't lose it. Now you have a benefit again, whether you live, quit, or die. So yeah, for sure are really more appealing than the older school policies that were available, 20, 30 years ago, even 40 years ago.
And talk to me about that when you say live, quit, or die. Obviously, live, we get that. You live, you never need it. Or you do. We know what that prospect is. Quit. Explain that so people understand.
Absolutely. So with the traditional policies, if you change your mind, you can't get any of your money back. So on these newer type policies or these asset-based long-term care policies, when I say the phrase live, quit, or die, so live and need care, you have tax-free, which is, again, a great efficiency, leverage for long-term care purposes. If you want to quit, as I like to call it, there are we call exit strategies. So most of or actually all of the policies you can take some or all of your money back, depending on when you change your mind. So, if you change your 10, 15 years in, you say, hey, I'm not going to ever need care. I want to go to Vegas and spend all my money. You have an exit strategy. You can take some of your money and you can actually get out of the contract. So, there really is a lot more flexibility with those policies, especially on the exit strategy. And again, if you wake up an angel and you never need any care at all, on the traditional plans, there's no death benefit. On these asset-based LTC plans that are typically written on a life insurance or annuity chassis, your beneficiaries are going to either get a death benefit or they're going to get an annuity. So that's beautiful. Again, in my opinion, that's where most of the policies that are sold in today's atmosphere, they're typically going to be the asset-based because you have those guarantees and people prefer owning versus renting, even though there's a place for renting, right? That makes sense.
It makes great sense. We're going to talk in the future episodes about like long-term care riders on insurance, life insurance. But what we're going to talk about today, and we're going to kind of, get into some case design so the people out there can see really behind the curtain. If I do this, this is what I get. So, but I want to make sure people understand we are talking about true long-term care, tax qualified plans where long-term care is the primary purpose. Okay. So when I'm talking to someone about long-term care, I want them to have something in place. If long-term care is the issue, this is the direction we're going to go, what we're getting ready to talk about. If it's hard for me to get them to even look at me straight in the eye when I say the word long-term care, we may go another direction. I'm going to talk about that. But I wanted to have an opportunity for Alecia to walk with us through some cases. So let me share my screen, and we'll talk about a couple scenarios of, how to leverage your dollar for good. Okay, so let me pull this up and go backwards because I just went through it again. So talk with this. I'll set it up and then I'll let you talk through the cases. But what I love about the scenarios that are going to be discussed is it's a couple, right? And a lot of times people think, well, I have to have two separate policies. You can go that route, but you can also have one policy that covers two lives. we see in statistically that in a married couple, one most likely will need some type of long-term care, perhaps both, and that these policies and these scenarios allow for that. So in this scenario, 65 and 62, so not spring chickens, but right, but they're still going to be able to get the policies. The first one is a couple who one of them had a $200,000 IRA, and we are going to demonstrate moving that to Nationwide, A-rated insurance company, been around a long, long time, phenomenal whole life product called Care Matters 2. And just so you understand the way it's funded, this policy is the $200,000 is going to be transferred to another IRA, but in a investment vehicle called a single premium immediate annuity. And that $200,000 is going to kick out premium every year for 10 years to fund the benefit. And we'll talk more about that when we look at the case. The second scenario is the same situation. It's just a different company, different product, and it's all done internally with that same company. And then the third scenario is a $200,000 non-qualified or after-tax account, and it's moved to an annuity, growing in value, but yet has a long-term care benefit attached for both people. So in the first scenario, Alecia, let's talk through this.
Absolutely. And I will add a little bit of color to this, just so you don't get caught up in some of the minor details here. You can really fund these plans with any asset under the sun. So just know that really any asset under the sun, whether it's income, whether it's cash sitting in the bank, qualified dollars, meaning IRAs, didn't pay taxes on that money yet, old life insurance policies, maybe that you don't need anymore, or highly appreciated non-qualified annuities. So what Amanda and I have found is that a lot of people save money in pre-tax dollars, right? Because our employers match. So we have a disproportionate amount of money in qualified funds. So this first scenario, and I like to use the analogy, you can buy your McDonald's Happy Meal or you can get your hamburger, fries, and drinks separately. So this first scenario is buying your hamburger, fries, and drinks separately. So we're going to roll money, like she mentioned, from our left pocket to our right pocket. We're going to put that IRA or that old, qualified account, we're just moving it from our left pocket to our right pocket, tax-free, into a single premium immediate annuity. And as she mentioned, it's going to spit off money. So what does that $24,000 buy for this couple? So it's going to give them, and keep in mind, this is all tax-free for care. Now, we're never going to get out of paying Uncle Sam. So I'm going to say that real loud for the people in the back. You will have to pay taxes on those dollars. But what we're doing is we're spreading that tax liability out over 10 years. So you'll get a 1099 at the end of the year to pay the taxes on that money. But what we're doing is paying taxes while they're on sale. And again, we're spreading the tax liability out. So here's the important part. What does that $24,000 in this scenario buy? So it's going to give them each $62.82 a month cash benefits. So if they need care, day one, $62.82 a month per person for 8 years shared between the two, or 96 payments. So they're also very young. We're going to put 3% compound inflation on that. So that will continue to grow each year, the monthly benefit, and what I like to call a tax-free long-term care bank account. So day one, you're getting $670,000. So think of that as a tax-free bank account, and they'll get a check for $62.82 a month until that bank account is gone. Again, that's going to last 8 years shared between the two of them. They both need care at the same time. It'll draw it down twice as fast. Now, they're young. They may not need care for 20 years, for example. So now, or let's just use the example that it shows on here at age 80. So we're growing that benefit every year. So at age 80, now the monthly benefit is $97.86 a month. So that's going to go to pay for whatever type of long-term care services you want. I know Amanda and I want to receive care in the home. So we could use in that example, that entire $97.86 to have someone come in and take care of us in the home or in an assisted living or wherever you want. This is very flexible as far as how you use that money. But again, we're not going to need care today. So what's it going to look like at 80? So that's our new monthly benefit. But that money is going to turn into $1 million or a little bit over $1 million at age 80. So we're leveraging 200,000 and we're getting over $1 million of tax-free benefit for care if we need it. The average age of claim, by the way, is age 80. So that's why we always talk about today's dollars and at age 80. If you needed care later, it would be more because that inflation is growing. But just to give you, again, a 10,000-foot overview. Now, here's the beautiful thing, and this is another reason Amanda and I love these solutions, is if you don't use it, you don't lose it. So we talked about that a minute ago. It has a live, quit, or die benefit. If you die and don't use this, it has a $226,000 death benefit. So someone's essentially getting your money back. Now, this is not an investment. We're not looking at big life insurance death benefits. It's, oh, by the way, if you don't use it, you don't lose it. So we're, again, turning our taxable dollars into tax-free for care. If we live and need care, we have that $1 million bucket or pennies on the dollar leverage, tax efficient, because everything comes out tax-free. We've got our death benefit, and of course, if we change our mind, it has cash value. So it's a great way to utilize the qualified dollar. Now, again, we're piecemealing it together. We're buying that hamburger, fries, and drinks separately. Scenario 2 that we're going to go over is the McDonald's Happy Meal. Does that make sense, Amanda?
Yes, I love it. You make it sound so, I'm hungry now. I want to go buy it. But I also want people to understand planning, right? Like we said, self-insure. So what's my solution? If I don't have something like this in place, right? And I leave that $200,000 in the market goes up, market goes down. Let's just say we're in the middle of a correction in the market because that's the nature of the market.
Yes.
And it's qualified money, so I haven't paid tax on it. And now I or my husband need care, right? Well, I'm not going to wait for the market to go back up before I make a withdrawal. I'm going to go to my account. I'm going to sell at a loss or a gain, depending on what the market's doing. I'm going to pay tax. And most people do believe tax rates are going to be increasing in the future. And then I'm left with whatever is left over. Or I could take $200,000 and have $1 million of protection. Hey, I mean, it's a no-brainer to me, but let's just keep going. We'll go to the next one. All right. The other thing I wanted to mention about this particular product, though, it's an indemnity plan, so you don't have to turn in receipts, and that can be frustrating. So we'll talk about that on another level. The next scenario is same couple, and I love this product because, well, I'll tell you in a second. You got to hold on. So this is Mr. Second scenario, and he has a $200,000 IRA as well. We're going to transfer it to a company, One America product. That's the company. The product is Asset Care. Once again, 10 years, that $200,000 is going to kick out a $25,000 premium. Day one, $7,038 per person benefit, but it is what, Alecia?
Unlimited benefits. So for someone who, this I love, right? Like there are a lot of great solutions out there, but somebody who wants true longevity protection, let's say you have Alzheimer's in your family, which the average age of claim, by the way, or the average, not age, duration is 8.2 years. So that's a long time to be paying for long-term care services. This is unlimited, so you can never outlive your benefits. So again, I like to call it the McDonald's Happy Meal. You're going to move the $200,000 over. They're going to do everything for you. They're going to take distributions each year to fund the life insurance policy. You're going to get 1099. Again, remember, not getting out of paying Uncle Sam. So that $25,000 is a taxable distribution. But thank goodness we have a $7,038 a month per person tax-free benefit for long-term care services for as long as we live and for the rest of our lives. So that to me is the most catastrophic coverage that money can buy. It's all done for you. Again, McDonald's Happy Meal. You can set it and forget about it. And if you never use it, you can pull it out of the lockbox and someone is going to get $234,000 of tax-free death benefit. So again, we're getting to the same end result, just two different ways of funding that plan, which is why I always say you can fund these with any asset under the sun. And there's 101 different ways to do it. That's good news and bad news, but that's why Amanda works with someone like my team, me and my team here at Financial Independence Group to do that heavy lifting and decide, hey, what's the best way to fund your plan? But we love that solution, don't we, Amanda?
Oh yeah, I mean it's by far my favorite when long-term care is truly a concern for a client. This gives them the peace of mind that nothing else will, right? I mean, it's amazing. So the last one, and then we gotta go. With show's almost over. Is a same couple, but this is an after-tax account they had, and transferring it to One America. Once again, same company as the last scenario, but it's to an annuity, and so it is pretty great leverage as well.
Oh, thank you, Amanda. This is one of my favorite solutions as well. So where that we see this as a big fit is, let's say you have an old annuity and maybe it started off at 50 or 100 and it grew to 200,000. So most people know that when you have to take distributions out of that account, you have to pay taxes on the gain. So we can actually utilize that money. The government has allowed those funds to be accessed tax-free for LTC. So we could move that from our left pocket to our right pocket, or we could potentially stroke a check for this as well. But if you have an existing annuity, you're not using it for income, it's got a lot of gains, this is a more tax-efficient way to pay for care. So again, we're going to move it from our left pocket to our right pocket. Now that 200,000, this is showing you the value in 10 years. So their 200,000 is now worth 207,000. And if they need it for care, that 200,000 now is $707,000 of tax-free benefits for long-term care purposes. Yeah. That right there is tax efficient, pennies on the dollar leverage. It is the reason that we buy insurance. And if you don't ever use it, guess what happens? That 200,000 and whatever it's grown to is going to go to your beneficiaries. And that's the guaranteed numbers, right? That's worst case scenario. Let's say that it's a great fixed interest rate and we are earning more gains. Then now our 200,000 is equal to, in this example, 751,000, and they'll be able to access that on a monthly basis to be able to pay for care. So again, it's a great way to utilize those non-qualified dollars in a more tax efficient way. And if they don't use it, they don't lose it. And if they change their mind, we can take some or all of our money back when we, depending on if we want to have that exit strategy. So you've got that live, quit, or die benefit. So again, another great solution, especially if you have old non-qualified money you're not using. You can even use that same solution with your old life insurance policy. So you've got cash value. Maybe your kids are grown. You don't think you need the death benefit. Your house is paid off. You can move that from your left pocket to your right pocket and provide the same exact amount of benefits with the exact same policy. So a lot of different ways that we can utilize it. Not a one-size-fits-all approach, but it's really exciting to see kind of where we've been in the industry to where we are now. And I think that the future is only looking brighter. So more and more carriers understand that long-term care is an important subject matter. And I know we're in the business of having uncomfortable conversations, but it's time to really get out there and help more people. And that's why we're doing what we're doing today, Amanda.
Yeah, well, Alecia, I love your passion. I love that I'm able to when I have a client with a need, I'm able to reach out to your team, and y'all are scouring hands available to find the perfect fit for each client. And like you said, it is not a one size fits all. So thank you so much for taking time out of your busy schedule, because I know you have a busy schedule, and spending some time with us here at Care Conversations with Clarity, where we really are seeking to create a community of curious consumers who want to understand complicated topics that touch retirement. Thank you very much, and we'll see you next time. Thanks, Alecia. Join our Clarity Financial Solutions family, where through education and others' experience, we empower you to make retirement choices with confidence. Follow us on Instagram or Facebook, or head on over to our website and sign up for our newsletter. If you'd like to further engage with us, please don't hesitate. Just reach out, 864-987-8729. See you next time on Care Conversations with Clarity.